All right, friends, we are looking at Nvidia stock today. And oh, wow, what a winner this thing has been. Since 2013, it started at a PE of 14.25. And if you go to today, you've gotten an 8,670% return. It has turned an initial $10,000 investment into $872,000, which is just absolutely insane. Actually, it's turned it into $877,000 when you include the dividend, right? But who's counting? So the question we have to ask is the price sustainable from current levels, and what do future returns look like? And I think the best way, there's a lot of excitement around Nvidia right now about AI. And so what we have to figure out is, does it deserve a super premium multiple to trade at a PE of 79? What is that PE even like comparatively, and what might happen in the future? The truth is, no one knows what's going to happen in the future. I don't own any Nvidia stock. I'm not short Nvidia, and I'm not planning to short it. But I think what we need to do is look at Microsoft from its early days, right? And so this is Y charts. And if we take a look at Microsoft, this is Microsoft's market cap since 1987. And if we look, it's turned a $10,000 investment back in 1986 into $30 million. If you just put $10,000 in and held $30 million, that's insane, right? But what I want to focus on is 99 and 2000, right? So just by 99 or by 2000, it had turned your $10,000 investment into 8.39 million. Let's look at some of the fundamentals of the stock at that time. And there's a lot of similarities actually to Nvidia right now, right? And that was right before, if we look at the market cap, January 4th, 2000, $577 billion. It dropped down to, and again, this is the dot-com bust, right? But still, it dropped down to 221 billion. So that is more than a 50% reduction. Let's look at some of the fundamentals of the stock at that time. All right. Trailing 12-month revenue. At that time, they had 21.86 billion. And I'll actually pull Nvidia up on a lower chart right here. It might be hard for you to read, but I'm reading these numbers to you, so I promise they're accurate according to this. Okay. So back then, at Microsoft's peak before the dot-com bust, had a market cap of 589 billion, revenue of 21.86 billion. So 589 and 21. Right now, Nvidia has $690 billion market cap and revenue of about $27 billion trailing 12 month. Okay, so pretty close comparison there. Let's look at the PE ratio back before that big bust. Okay, that's the blue line added on top. Microsoft PE ratio 71. Right before it crashed, 50%. Okay. Nvidia PE ratio right now, 160. So it is double what Microsoft's PE ratio was before Microsoft lost 50% in the dot-com bust. Let's look at annual revenue growth. And I'll actually take the revenue and PE out just to keep these clean. So back in 99 at Microsoft's peak, annual revenue growth was 29% per year. Nvidia revenue growth right now, 0.22%. Profit margin, we'll take revenue growth out, we'll put profit margin in. Profit margin of Microsoft in 99, 40%. Profit margin of Nvidia right now, 16%. And so now, instead of looking at Microsoft's historical return, let's look at what happens if you had invested in Microsoft right at the peak. What happened to the money that you invested? So we'll go back. Okay, so now we're looking at Microsoft right at that peak, right? What if you would have bought Microsoft at its peak in 99 at that high PE ratio? That's only half of what Nvidia's PE ratio is right now, when Microsoft had a little bit less revenue, a little bit lower market cap. But I think they're pretty comparable, actually, much more profitable than Nvidia at the time. You would have lost, so if you invested $10,000, by 2001, you would have lost, you'd be down to $5,000 by December 27th, 2000, because the stock dropped 50%. And this is total return, right? And over the entire time, so remember that crazy return we saw for Microsoft, over that entire time from that peak that you bought at, your $10,000 is now worth $100,000, which is still a nice return. But if we're talking about 23 years, that's a 10x and 23 years. Now, if you would have waited, let's just say you didn't even catch it at the bottom, but you invested in October of 2000, October 4th of 2000, October 4th of 2000, your $10,000 investment then is now worth 165,000. So 16 times your money versus just 10 times your money. And when would you have bought that stock? What PE ratio would you have been buying that stock at? You would have been buying that stock at a PE ratio of about 30, about 33, which is, still pretty high back then, but not as absurd as 70. And now you're at a PE ratio of 32. And so if you're going to own Nvidia here, what you need, and this is the PE of Nvidia, you need the PE ratio for this investment to work out. You need the PE ratio to stay really high, right? And so what I did was I just took analyst estimates. So over the next, through 2028, analysts are expecting revenue growth of about 21% per year, net income margin at about 46%, free cash flow margin at about 29. And so what I did, I threw it into this little calculator and I did revenue growth of 18, 20, and 30%, which remember that's higher by far than the analyst estimates. And this is over the next 5 years. Profit margin of 35, 45, and 45, which is on the high side. Free cash flow margin of 25%, 30, and 30 on the high side. And then a PE 5 years from now of 20, 30, and 40, which is still higher than Microsoft is today, right? On these two ends. Same thing with price free cash flow. And then our desired annual return is 10%, 13%, and 15%. And so what we're doing is we're building a scenario of possible things that could happen if they hit these numbers. You might think Nvidia is going to be way higher than this. I would be curious about the justification of that at the 5 years out with the amount of revenue that they have, how they would sustain higher growth than 30%. I would question that, right? But I think the low side is at least not too overly ambitious, and they'll probably land somewhere in the middle is how I feel over the next 5 years. We hit analyze, and based on these scenarios, if you believe in the low scenario, you'd be buying, depending on if you're doing free cash flow or PE, between 86 and 120. Stock's currently at 280. In the mid scenario, 139 and 209, still not a buy. And then the high scenario, if you believe the high scenario and you're looking for 15% annualized return, which that's more risks because you're expecting the high scenario, you'd be willing to buy it at 243 or 364, which the price is 280. But that high scenario means 30% revenue growth, 45% profit margin, and a 40 PE if you're looking for 15% annualized returns. So for me, I love Nvidia. I love the stock. I love everything they're doing. I don't love the stock price and the valuation, and that's why I'm not going to be investing in Nvidia in the near future unless we see some serious multiple contraction, which could either come from the earnings growing and the stock price staying flat for a very long time, or more likely, I think, is that we see a pullback in the stock price, especially after they report earnings and some of this AI excitement goes out, or things keep going crazy. But I don't invest on a basis of hope and craziness. I invest on fundamentals. If you like that stuff, like the video, subscribe, and come back for more. Let me know any other stocks you want me to review.